All right, it's that time for our trader talk, and the man of the hour is Sean Udell. Sean, good morning.
Good morning. How are you, Jim?
I'm doing quite fine. Just in case those who don't know, Sean is Tech Trader, Tech T, as he is known as his trading ticker as well. So I do have some questions relating to the tech space, as we typically do. Last week, towards the end of the week especially, I saw a nice little run down in the NASDAQ and quite a impressive reversal. A nice three-day rally if you count from jumping off of the Friday lows. And in particular, I've noticed a big reversal in a lot of these software names. So I wanted to get your take on this because you've been somewhat bearish on that space in particular.
Yeah, I mean, I think the best way I can look at the space now is I think the space has become very easy. And what I mean by that is, well, in fact, it's just the same as it was when I liked all the names that are the hot names now. So excuse me. So when I liked NTNX from low to mid-teens, that was basically the same time Mule was low 20s before they got bought out. That was the same time Coop was 25 to 33-ish. That was the same time Okta was 26 to 30. So the group was very easy then because the whole group was basically mispriced for growth. So you had very, very high growers. I guess people didn't think the growth was as durable. By the way, Twilio was another one. Either people didn't think the growth was durable or they just were uninformed and they didn't know. And that it's probably a little bit of both, but it's probably more the latter. And I think we have the same situation today. So where are we today? It was roughly 2 years later. And I'll talk about Nutanix specifically because I think there's some really interesting, I have some interesting insights on that relative to the space it's in, valuation, the NVIDIA deal for Mellanox, etc. But just to wrap up this current point, the space is very easy now because basically almost all the names in the space are uninvestable as longs. Unless you believe you're willing to take. It's just like I said remember when I said, hey, you can be long FANG if you're willing to tolerate 50 to 35% downside. Or maybe I said something a little more specifically like, you probably shouldn't be long anything in tech unless you can withstand a 35 to a 50% decline in FANG. I think that was my. So how I would look at the cloud, most of the cloud names now, I'm like, hey, you can be long these names if you can withstand a 35 to a 50% drop in most of them. And I do think that's going to happen at some point. It's the risk reward just is extremely, extremely unfavorable. So I've gone from uber bull on most of the high growth cloud names to zero, non-interested to outright bearish. Now, the juxtaposition is I liked TLND in the 30s. They had a good report. They're 47. All-time highs are 30 points higher. That name roughly has similar growth to all the names I kind of just talked about. It might be a little lower than a couple, but it's a lot. It's actually higher than quite a few. Now, that's a very cheap name. Even after the bounce, it's very cheap. It's not cheap if you look at it like classic metrics, even for software. But, you know, most software M&A gets done roughly 10 times sales for a decent grower. Talent isn't even trading 10 times trailing sales. It's only 7 times trailing sales. So if you just sort of believe, look, these guys might get bought, there's 35-40% premium just on trailing sales. And they usually trade more like 9 to 10x forward sales. So on forward sales, this is a lot more attractive. And again, this is after a 20-30% pop off the lows. Another one's Cloudera. They report later this week. Got a really interesting question, which I try to keep my answers to questions short. It was such an interesting question, I made it pretty long, the response, and I covered quite a bit of other information in that response. I think Cloudera is incredibly attractive. The only issue is if you've waited this long to buy it and you don't have any, I'd probably wait. In other words, I don't like to buy stuff the day or two before the print. I really don't like buying stuff 2 hours before the print. But if I'm in something 2 to 3 weeks, better yet, 2 to 3 quarters before the print, 2 to 3 quarters is way better. So you know, I'm in Cloudera multiple quarters before the print with lots of trading gains and lots of cushion. I mean, literally, I've bought this name every time it's gone to 14 and change since the IPO. So, and I sold every top except the M&A spike top. I sold every top in the stock. Either sold it all or sold a lot of it. So Cloudera is like TLND. It's incredibly cheap for growth. And I think I wrote this up in another longer post, I don't know, a few days ago. I think what's going to happen with most of this group is the same thing. This is going to be a long tail, but the same thing that happened to hardware, and that the most expensive solutions in technology get commoditized over time. So who has the most expensive solutions? Former names I love, like Splunk. Still really like Splunk. I just can't buy it here. I don't know where I could buy it, but I can't buy it here. And I said, hey, that 140 is nuts, and it's pulled back huge from 140. So in fact, Splunk at 140 was very similar to Splunk at 55 or lower. So it was basically the same. Again, the group's pretty easy now, I think. But there was one more name in the space. Well, okay, so like Pivotal. Pivotal is not as cheap, but I think Pivotal's growth is going to be very long-tailed. Now, Pivotal might go down if the whole group sells off and they don't love this report, but Pivotal is something I'm very comfortable buying on sell-off. It's pretty much my favorite growth name in the space, either that or TLND. Cloudera is probably my favorite totally mispriced name in the space. I'm trying to think if there's a, I mean, but so that's kind of how I line it up now. It's like all the stuff that was super attractive 1.5, 2 years ago is stupidly unattractive now. But there's still some attractive names in the space, and interestingly enough, the stuff that's attractive now might have more upside than it ever did, because either one of two things got to happen. Either they got to put forth a huge catch-up play if the other stuff doesn't correct, or maybe the cycle set and some of them have competitive advantages and can take advantage of sort of the future state of where the growth is going to be. And again, that's why I like Pivotal. That's why I like Cloudera. And TLND is more of a, I like it because it's cheap relative to peers. You know, they basically compete in the Mongo, Splunk, Varonis type space, you know, big data analytics, stuff like that, and so they're by far and away the cheapest name in that particular area. So you can fire away, but that's how I pretty much see the group now. I think there's a few good buys left. Those buys are probably going to struggle every time, or those names are probably going to struggle every time there's a big group sell-off. But I still think there's a lot of advantages, and in Cloudera specifically, the long-term advantage is that if the space is commoditized and things get cheaper and people seek out lower cost solutions, they basically have the monopoly there, because they have the crowdsourced open source platform with much cheaper prices for entry into their tools, versus, again, the Tableaus, the Splunks, the MongoDBs, etc. But I don't know. I'm not crazy about this quarter. Maybe I'm just using reverse psychology. The only thing I don't like about this quarter, it's kind of the opposite of a post-IPO quarter. Like the one time you can almost always just take a trading shot on the long side is the first quarter after an IPO, because there's almost no way a company. I mean, you pretty much know you're going to get a beat. The only thing you have to worry about is the stock too hot and does it sell off just because it's too hot. But you pretty much know the numbers are going to be good. The only issue I have with Cloudera short term is this is the first report post merger completion, and I'm not saying they're going to do it. It's really kind of a coin toss. If the quarter is good and the guide is good, Cloudera is going to go. It's really going to go. But if there was ever a time for senior management to kind of lower the bar or set the bar low one more time and sort of, you know, not kitchen sink a guide, but definitely guide pretty conservatively, and sort of set up future quarters very nicely, it would be post-merger, right? Because you could always say something like, well, you know, we have sales team integration issues, and yeah, we have some layoffs, and you know, we're trying to figure out who's going to cover some, you know, our biggest customers. And, you know, by the way, again, I don't know that's going to happen, but I've been around the tech space long enough to know what the risks are. And the short-term risk is that, you know, they just basically use this first quarter post-merger as a conservative guidance moment. You know, Twitter's done that several times, not necessarily on M&A, but, you know, when Jack Dorsey came in, they lowered guidance a lot. Most companies sort of have a post-merger digestion period. So I think most of it is priced into Cloudera. I mean, hey, unlike most people, I would relish a big sell-off in Cloudera because it would allow me to buy more. And most people want the name to work and want the name to keep going up and never drop. I'm not like that. I embrace sell-offs. They give me an opportunity to make more money. So and again, I've raised a lot of cash since, especially the last 2, 3, 4 weeks. Pretty much been trimming lots of things as the market's been zooming higher. So, you know, I'm in a much better position to buy a whole lot of it now than I was in November and December, because I didn't sell anything in November and December, kept every single long I had, and press longs even more. But you know, my capability of buying stuff on dips now is massively larger than it was like by the time we got to December 24th, because I'd pretty much maxed out. By the time the market hit ultimate lows, I'd pretty much bought most of my buys. Still squeezed a few in between December 24th and January 5th. But, you know, the bottom line is a sell-off in one of my favorite names would not bother me at all. So I'll close there, and you can fire away with anything you want.
All right. So we're going to touch on the handful of names that you like in this space, but I want to talk about how difficult it is to short this, because for the most part you illustrated that a lot of these names are, in your opinion, uninvestable, which sounds like you would be bearish on the group, and for the most part you are. However, many times, and I've seen it just watching all these charts, let's just look at Twilio, for example. Looking at Twilio, it was a name that you didn't like, but every time you, not you specifically, but if one was try to short this one a lot, they would get burned. They get a nice little
Well, remember too,
day.
I was the most bullish guy on the planet on the stock when it was $30 and below. So yeah, I've been wrong from a higher price, but I was exceedingly right when it was cheap, when it was sort of the point of maximum opportunity. But I agree. I mean, hey, I'm not posting a lot of shorts, you know, because the short side's kind of tough. I mean, it's like FANG. Until the whole group decides to really roll over, you know, momentum's powerful. People are going to chase the high flyers. People, you know, the worshiping at the altar of price momentum is one of the strongest trading gods there are. You know, I don't worship the altar of price momentum, but you're right. It's until it cracks, it's hard to. Put it this way, it's really hard. It's hard to get a short and really get a satisfying gain short term. You know, 6 months from now, a lot of these might be quite a bit lower. And even if the market's higher. But yeah, it's like I say, I don't really see, I don't know. I don't really see the short setup as being so exceptionally good that I'd rather be short these. I'd rather be net short cloud software. But yeah, I mean, there's very few names I'm willing to put my own money at risk.
All right. So the names that you are would be CLDR, TLND, and PVTL. These are the most attractive ones. Am I leaving any off?
And NTNX now. NTNX. So here's a great example. You might see in most of these names over time the exact same thing we just saw. I mean, I lost count of the number of times that people said, hey, is NTNX a buy at 48? Is NTNX a buy at 55? It's pulled back from 65 to 52. Hey, it's 42. And I never, you know, I said, it might be. I mean, I think at the lower end of the range, I probably said, I think it's okay. But I didn't touch it. Didn't buy it. Took a tiny little piece into the earnings report, but that was mainly just because I trade something better once I have it on. And then I added to it nicely post-report. So 34. I sunk my teeth into that pretty good. So, you know, I think that is a very easy long versus all these other super extended longs. And it might be sort of short-term, unsatisfying. It might bounce to 38 and drop to 35.50 or 36, you know, kind of head fake here, head fake there. But now, guess what? Nutanix is nicely attractive again for the growth. I think the downside, it's like buying a great used car, letting the original owner of the great used car eat a 50% drop in price. And you can scoop in and buy the thing with 8,000 miles on it or something like that for, you know, half price, you know, 2 years later. So if you got to buy a new car, you're going to pay up. If you got to buy a stock at all-time highs, you're going to pay up. But you know what? Nutanix at 34 looked really good. And I did not like that name at all from, you know, 50 to 60 bucks. And that was a three-bagger for me. Off lows. So not my whole position wasn't a three-bagger, but a pretty good chunk of it was. So, so yeah, I mean, like honestly, again, this is how I think. Doesn't mean everybody should, you know, this is how I think. I don't advise, I talk about what I'm doing and why, and everybody else can use that information or not. But I can buy Nutanix, I can't buy Twilio. It's that simple.
And if anybody wants to get a sense of how TechTrader looks at things, you can simply look at a chart, and that'll paint a really good picture of things that he likes and things that he doesn't. He does look for value in the tech space in a very opportunistic way. Doesn't have any problem holding things throughout the quarter, throughout the print. Speaking of the print, we have one in CLDR coming up, and I know you already touched on this a little bit, but since they're out tomorrow, if one wasn't to already own this stock, would you be encouraged to jump on it ahead of this print or wait till after?
I mean, again, I posted a really long note on that exact question yesterday. So anybody that has that view, read the note. I would probably say no. Or maybe you could have a small partial, you know, a third at most, a quarter, an eighth, I don't know, whatever a small partial. But here's why. I mean, I've bought this name multiple times at 14, 50 and lower, and it's been a good entry multiple times, and went to 22 twice, went to 18 a couple times, went to 22 again. So you know, hey, if you've waited this long, maybe it's not the right name for you. You know, maybe you don't like it. Maybe it doesn't feel good. Maybe it doesn't set up for your style. But you know, if I had zero on right now, I'd probably wait for the print. Now, because my view of it would be different, I think. If I had zero, so that's the thing. I'm trying to put myself in the seat of somebody that for whatever reason they haven't looked at it and seen the value. So, you know, if that's the case, then you know, the beautiful thing about the market is we get pitches all the time. You know, this is a Warren Buffett quote. You know, the beautiful thing is we don't have to swing. We only have to swing at the pitches we like, and there's almost an infinite number of them. So, you know, nothing says we got to swing at every pitch. But yeah, no, if I had zero on and waited till this point, yeah, I'd probably see the print. At most, I'd have a small. Probably at most, I'd have a quarter on. Again, that's me. But I feel pretty comfortable with it. Again, I got cushion. You know, stocks up. The other thing I said in my note is sometimes the machines, in fact, I don't think the machines really look at relative valuation. That relative valuation impacts stock prices hugely over time. It's one of the reasons, by the way, we should talk about BIDU. It's one of the reasons I absolutely love BIDU right now.
We will.
So relative valuation works, you know, big dark pool trades, big hedge fund trades, you know, it's sort of like long-term momentum versus short-term momentum. But on day-to-day trading, post-EPS trading, I don't think the algos look at relative valuation metrics at all, because they just sort of look at, okay, hey, here's the headline print, here's this, where's the flow? If the flow's sell side, They just jump in front of it and sell more in front of it, execute sell orders, and drive the price down. So, so a stock can be exceedingly cheap on relative valuation metrics, but if the print just isn't sexy, it's probably going to go lower, right? It's there is some impact because you're seeing like every single cloud software company that's exceedingly expensive. No matter how much I like these companies, all the ones I used to own, which now I can't buy anymore. So none of them have acted very well on huge beats. So I mean, Splunk, gorgeous quarter. That's 20, 25 below. Workday, gorgeous quarter, same 20, 25, maybe 30 points below. Coop, gorgeous quarter, 10% off. Heartbeat off the day highs. Okta, same. Elastic, same. So I guess part of it too is what would Cloudera have to report to go up? And maybe it shouldn't have to be as good because the stock is literally trading at like a 80% discount to Coop. Maybe it's a 90% discount to Coop on relative valuation metrics. It's just crazy. It's hard to do a relative valuation metrics when one stock's 3 times sales and another stock is 20 times sales. I mean, that's how wacky things are. But I do them. Yeah, I do those relative valuation metrics, and they work really well for me over time. But yeah, if for whatever reason they just don't like the print, I don't know. We'll see. I mean, put it this way, me, I'm not a bit shy about saying, hey, I think the print's going to be good. I'm either buying more or I bought more. I'm holding all. By the way, I haven't sold any Cloudera. But I'm in a position to where I could buy a lot more of it if I chose to. There's a big difference too, right? I'm very flexible right now, extremely flexible. I can do lots of different things. I can short aggressively, I can long aggressively, I can add big stakes to things because I'm, again, got a lot of cash. So I think that, I don't know. Here's the best way to say it. There's times I feel, hey, I was short AOI and made a peak earnings call. Made a peak earnings call in NVIDIA when everybody thought the thing was just the best thing in the world and going higher. So I've made high conviction earnings calls in front of reports. Honestly, I just don't know. On Cloudera, could be really good. Here's what I know. If they don't guide lower, which this is my trading instincts just sort of think that they take the merger as a way to guide conservatively. I think it's a short-term sell-off if they do that. If they guide in line to higher, I think the thing goes. I think it goes. So that if there's a reason to at least have a partial, there's the reason to have a partial. Because if they don't guide, if they don't post-merger guide lower and do the conservative guide, the thing could make a really quick move to $17, $18. That's minor resistance. Above 18, there's no resistance. And again, my price target's $30 on the stock or something like that. So, and it's a conservative target. I view my target as, I guess it's 25. My target's conservative. But, everything in me kind of says, again, that's what I wrote up yesterday. I don't know, man. If I just didn't have any on, I'd just wait for the print. I mean, you never know. Sometimes you get a really good print and the stock's not up that much anyway. I mean, we're seeing that a little bit more too because I think because the market is so high, the indices. Sometimes, you can get a pretty good print and you don't really have to pay up that much for it. That's probably the other reason too. I'm not seeing very many reports right now that are gapping up 20% that don't peel at all. I mean, like AMBA. Okay, so you know how much I like AMBA. Now, AMBA didn't have a good report, but it kind of had a great reaction. But heck, as long as you didn't buy the post-EPS spike, 2 hours later, you buy that thing 3 points lower, right? So the post-EPS spike was 44, 45. If you waited 2-3 hours, you could have bought it at 41. So, maybe something like that happens to Cloudera too. Maybe the report's good, but it just doesn't spike that much. I think things are having a hard time spiking post-report right now. By the way, that all happened weeks and weeks and weeks ago. Early in the earnings season, that's when stocks were spiking good. Now, by the way, you could say, well, Stitch Fix is doing it today. Yeah, I mean, there's going to be one or two here and there. I'm talking about the multitude of reports. We kind of went through, first couple weeks of earnings season, any good report was spiking and holding and extending, right? Then, now the later the earnings season got and the higher the market got, the harder spikes have been to see, especially to hold. So part of it's a market backdrop feel too. I just don't see that, where the market where it is, there's just not very many names spiking and running away. Now, by the way, Stitch Fix is kind of an interesting thing. A big reason it's acting so good today isn't so much the report and the numbers, which were good and the guide was good. It's that the stock was one of the few stocks that really hadn't gone up a lot. I don't think Stitch Fix was 45-50% off of December lows. I'd have to look, but I think it spiked and it had a pretty good sell-off recently. In fact, I think it did. I think it went from like 28 to like 24 or something, or 23. Here, let me look. Stitch Fix. Well, it was 25 pre-print. Yeah, I mean, it had at least a little bit of a pullback recently off the highs, and I guess it was up a little bit off the year-end number. But that year-end low for Stitch Fix was exceedingly low, as CLDR was at 10. At 10, it was just absolute no-brainer. Anyway, not to spend too much time on it, but again, people can read my post yesterday. That pretty much says it all.
Yeah, I'm going to school you on something here, TECHT. When you're on the air, and I was no broadcasting major by any stretch, however, when you are on the air, you don't tell them to go read something. Give you the opportunity to state your case on the air and show your brand off here. Don't tell them to go read it. Taken away from your vocals.
I reiterated it, so I just don't. I don't think we need to spend more time on it.
I'm just messing with you. But a lot of people didn't hear or didn't necessarily see that particular post. And you do have a platform, so that's why I wanted to get that one out there. So,
fair enough.
All right, so why don't we talk about BIDU, because this one, I'm sure it's frustrating a lot of people. It hasn't done much well, let's see, dating back to the last couple of months. We had that dive lower, maybe found some traction at the end of December, but really hasn't done a whole lot. You like this one still. State your case.
Well, okay, now this is an example of something this looks exceedingly attractive versus pretty much any and all cloud software. Again, I mean, hey, CloudAir is kind of like this. Pivotal might be kind of like this. So TLND at Talent at 35 might be kind of like this. But this is just one of those great things that doesn't make sense. This is similar to Apple in 2013, Google in 2010, BIDU at various times in its own history. And by the way, I haven't recommended long in this very, very, very long. I mean, so if somebody's frustrated, like, hey, if you're frustrated after a week on a stock, well, I don't know what to say, because it's a very, very short period of time. I don't know. I'd have to go back and look and say, exactly when I posted my long. I don't think it's been a month. So for me, that's a minuscule amount of time to hold the stock. But this is just relative valuation nirvana. You got trading 3 times net cash plus investments. So it's not. That's net of debt though. So you take all cash, all long-term investments, and their stake in IQ. Other investment stakes, subtract debt. It's 3 times net cash. Apple was trading between 2.5 and 3 times net cash in 2013. You see a lot of technology companies, if they're in trouble, trade 2 or 3 times net cash, sometimes even 1.5 times net cash into a big sell-off. It's very tough, or it's very rare to see a high-quality stock, let alone a country industry leader. I mean, BIDU is arguably it's the best stock in China, in my view, best company in China, most investable company in China. But yeah, if you bought the stock 4.5 years ago, you probably would have paid anywhere from $40 to $60 higher. They've doubled their revenues in that period of time, and again, you can buy the stock 60 points below what you would have paid 4.5 years ago. So to me, it doesn't get any more clear than this. maybe the chart needs to do a little something. Maybe there needs to be a catalyst. Maybe, I don't even care. I know there will be catalysts to come. In a stock like Baidu, there will be catalysts to come because they're an aggressive investor in their company. Just long-term bull case. I had a great interview with somebody. I don't know if I'll post the link if it shows up. Somebody's asking me questions about Apple yesterday. And, as you know, I don't like Apple, haven't liked Apple for a long time. But he was saying, well, hey, there was a time when Nokia, was Apple, and then Nokia ceased to exist sort of in the smartphone. Do you ever say, I'm like, yeah, I don't really see that happening for Apple. So great companies with huge stockpiles of cash and resources and talented people tend to grow pretty well over time and maintain dominance. And yeah, sometimes they do fall on their sword. Baidu has an exceptional advantage, though, is they're literally protected from competition within their borders. So they don't have to really worry about the great U.S. internet companies beating down their door. In fact, they can utilize the technology being developed by Google and kind of follow the Google roadmap, which in many ways they do, and grow nicely. So no, it's very cheap. Three times net cash plus investments. That's about as cheap as a value you're going to get on a great industry leader, country leader type company. Here's this is just trading, Phil. I actually like Baidu's chart. By the way, I like the chart. Some people might not like the chart. I like the chart. I think this is a great chart. By the way, if go back and look at any of those cloud stocks when I was long them. This looks a lot like the charts that they had. The only difference is Baidu has a lot of history those guys didn't at the time. But similar formation over the last 6-8 months. But the other reason I really like it is we're seeing some pretty good lift in a lot of Chinese names. The more speculative Chinese stocks have gone up quite a bit. One of the stocks that Baidu founded and has a huge stake in, IQ, has gone up a lot. And BABA in particular and JD have gone up a lot. So basically, if you just look at the move that BABA's made from 130 to 180, just whatever that percentage is, you pretty much can pencil that same move in for Baidu at some point. In fact, I think the Baidu move will be bigger because AI is going to be huge in China, and they're arguably the leader of AI in China. And I just think it's a better company, and I think it's got more reasons to be valued higher than Alibaba does. So I think that the move that you've seen from Baba, I think you'll actually see as much, if not greater, move in Baidu. And again, I can value Baidu very easily to where it was trading 4.5-5 years ago when it was trading quite a bit higher. Again, it's just not a stretch to basically put a roughly 2x multiple on it, or 2x return, because again, they've doubled. If you just say, look, it's traded this way before multiple times, and 4.5 years ago it traded at 260, and they've doubled their revenue since then. So all they basically got to do is if they go back to 2015 prices, you're still getting Baidu at a 50% discount to what it was trading then. So I like those odds.
But what's your take on why it's not participating with the rest of China?
I don't overly try to figure out the exact reasons, because and a lot of times, frankly, it's a waste of time. I don't really know if you can put your finger on why there's a great reason. There was a point at which Coop, Twilio, Okta, Mule's been bought out by CRM, by the way. Coop, that whole group of stocks traded exceedingly cheap. And we couldn't really put a finger on it. NTNX, that was the other one I was looking for. A couple had a little bit of a squishy result. There were some IPO lockups and stuff, but again, you had a bunch of stocks growing 2, 3, 4x faster than everything else in the software space, yet they were disliked. And at the time, people were still fawning over, I guess Adobe or something like that. So, maybe it was a chart effect as much as anything. But yeah, I don't really think there is a fundamental, the only fundamental thing could just be that to a certain degree, the Chinese market, although it's gone up and it's had a decent move off of lows, it's been very depressed for a number of years. And, until the Chinese-U.S. trade deal has firmer resolution, there's some broad Chinese weakness and things like that. So, BIDU is probably in some of these baskets that are easy to short if somebody wants to short. I mean, it's probably one of the top, to the degree there's the top 30 stocks in China, it's probably one of them, if it's not for sure one of them. So, maybe it's easy to short for people that want to have Chinese shorts on a macro basis and things like that. But yeah, I don't think they're, stocks don't need a great reason to be down. If they're down, what they need is usually they need something to get them to go up. And then once they start going up, the bear case kind of just fades away. By the way, I don't even really think there's a bear case. It's just the only bear case, we kind of talked about this, the only bear case is probably the chart. It doesn't have any buy-side momentum right now. But these things turn very easily. I mean, again, almost every name I've ever owned has gone from being hated to momentum, becoming a momentum name at some point.
All right, I'm going to get you out of here on this last one, and that's Qualcomm. This one has seen a nice rise off that $50 area. Let's just get a regular update from you because I know plenty of our listeners are in on this one with you, and we actually had somebody ask about an update. So what say you on Qualcomm now?
I still very much like it. There's still this supposed headline risk from what could be a harsh FTC decision. Again, I don't know if I share the same view as other people do. Again, my view is more of the consensus view where, I can value the stock materially higher, really whether the FTC says something good or bad or indifferent, because again, that's not going to be the final say anyway. The reason for the little bit of a pop, and again, I say little because it's really only moved about 8 to 10% off of lows, and the lows are pretty crazy. It looks like there's some people in the government that are starting to kind of, I won't say what I really think, but they're starting to get a little bit, let's say they're starting to wise up a little bit. I guess that's the kind way to say it, and start thinking a bit about this from sort of a U.S. technology strategy standpoint, security standpoint, long-term competition for global supremacy of 5G standpoint, et cetera. And it sounds like some of those people are kind of starting to listen to Qualcomm's argument about, how much sense does it really make that we try to neuter a top leading U.S. company in a very important long-term area, which would just essentially help China become a much stronger, better competitor in 5G. It doesn't really make any sense. I mean, I have my own views. And by the way, this is not just because, I'm an investor in Qualcomm and I'm bullish on Qualcomm. To me, this is just common sense. The whole FTC case, and honestly, to me, doesn't have a lot of common sense. Qualcomm there's not, they don't dominate the chip market. It's not anywhere close to Intel's dominance in certain aspects, or I mean, heck, you could even say NVIDIA's dominance in certain parts of the chip market, or Avago's dominance in certain parts of the chip market. So it's, there's no anti-monopolistic issue here. Their whole revenue model was set up on prior court precedent from cases that were won years ago, which the U.S. government had a large part in deciding the outcome of. Again, it was the U.S. I don't know if it went all the way up to the, this was their case against Nokia way back when. I don't know if that went to the Supreme Court, but it went very high. So I don't know. It's just kind of an odd thing that you would have a U.S. company, regulatory body working against a leading U.S. company. I could see if this action was being taken in China or the EU or something, but it's not. It's being taken by, a U.S. agency. So it's just a very odd it's just a very odd thing. It would seem very strange to cripple a very strong company in the U.S. For what? Okay, so maybe some companies shave a few dollars per handset off of what they pay Qualcomm right now or something. It just, like I said, the whole case just is dumb, if you ask me. Now, that doesn't mean it's going to be resolved the way I think it should be resolved, but it seems to me that Qualcomm's doing a lot of right things, getting some other people involved. I mean, I kind of wonder what would happen if they could get Trump in the room with them, with some national security people and some other people. I don't know. I mean, could this thing be thrown out real quick? Because I can't find any reason that it makes any sense. Now, the company that would probably disagree with me is Apple, but it's not like Apple can't afford to pay their suppliers on prior contractual agreements. So it just seems a little odd that the whole case seems weird to me. So again, we'll see what happens. I tend to sort of ignore the, you have to deal with whatever the decision is, but I tend to just value it on, hey, cash flow, revenue, and then the argument might be, well, wait, they're going to lose a ton of revenue. I'd say, well, most of the revenue that they're supposedly going to lose, they're not being paid right now. China has a lot of China revenues haven't been paid to them. I mean, they're literally not being paid billions of dollars a year. So that's probably the bulk of this royalty stream that they're not getting paid. So we'll see what happens. Like I say, I think the best bull case for Qualcomm would be just a reasonable resolution, but really it's how cheap the stock is relative to everything else now. So the interesting thing about Qualcomm is late in the year it held up as well as anything during the market correction, especially when the market correction got extremely severe. Qualcomm held up pretty well. I mean, in fact, it didn't even, I think, what was the low at the time, 53 or 54 late year. So while everything else was collapsing, Qualcomm held value, but while everything else ripped off of lows, Qualcomm hasn't done anything. So we'll see what happens, but you just, if the market doesn't correct and finds a way to keep going higher and higher and higher, Qualcomm just gets that much cheaper relative to everything else. So, if you get any kind of a favorable resolution, I mean, this thing could see, I see a lot of commentary that, oh yeah, this thing could pop $5 or $8. I don't even think that's anywhere close. If you get a favorable resolution, I think this thing is above 75 very quickly. And that might even be a deal that cuts their royalty revenue a fair bit, but is just not anywhere close to like the worst case. If you get a home run resolution, I honestly don't know where this thing's going to trade. Again, probably close to my price target relatively quickly. Because all of a sudden those billions of dollars, I mean, I calculate, done the math on this again, it's a range. But again, these are conservative estimates. I estimate that they're losing and they're not getting paid right now anywhere from 800 to 1.3 billion a quarter that they're just not getting paid. So, and that hasn't been paid to them for a number of quarters now. So all of a sudden, if all that money retroactively comes back and then starts getting paid and their growth rate kicks in, you tell me. Again, I think what's my price target on this? 199. I guess it's 109 right now. I don't know. I think that's really conservative, honestly. So, hey, if the FTC, brings down a horrible decision and they have to appeal, then it gets tied up in court longer, it's going to be a while. But again, I mean, this is exceeding. I'm using very, very low, estimates numbers to arrive at that price target.
Well, I am going to leave it off on that note because you had read my mind. My next question was going to be, what is your price target on this one? And at 109, that makes this one a double from here. And as you say, might be a conservative target. So that's some pretty good upside and a great place to leave off for today.
Yeah, no, that's hey, great conversation, and hope all is going well. But like I say, there, as high as this market is, there's plenty of things that we can still sink our teeth into if we're value hunters.
All right, Mr. Value Hunter. We will touch base next week. We'll talk about CLDR after their earnings report. I believe it's tomorrow night. And we'll talk about them early next week and what any adjustments may have to be made, or we'll let you pat yourself on the back if you're right. How's that?
Hey, sounds good. So yes, Cloudera, MongoDB, Semtech tomorrow, Thursday, Adobe, DocuSign, Pivotal. I'll have a note on DocuSign too. I've basically cleared out of that. I think I posted that already. So, but that could be another interesting report, especially on Acela. That's my closing remark with DocuSign.
All right, good stuff as always, Sean. Thank you so much for joining us today, and we will touch base next week.
Later.
All right, thank you. So there you have it. Some insight from TECHT, Sean Udell. Just to talk about some of the names that he did like in the software space. Cloudera, I talked about that one, although he's kind of on the fence whether he would buy it into the print, maybe small, but he wouldn't hesitate to buy it on weakness, but definitely was favorable on TLND, PVTL, and NTNX, NTNX. So barring anything unforeseen, we should have this archived for you later this afternoon. So if you missed anything, you can go back and check it out. Taking a look at the market, we've been hovering above that top of the opening range in the S&P futures, really tightly connected to that 2800 level. That's that level I was talking about. The longer we stay here, the higher propensity it is for us to lift off from here as the afternoon gets underway. So keep an eye on that.